2026. Lot of issues, lot of problems, lot of challenges, lot of opportunities. Now, from asset managers' lens, what do you think are the 2-3 macro forces that will matter the most?
Trading is going to be extremely tough in these markets. We would advise people to zoom out. It's going back to basics, going back to something which I think 1 or 2 generations before was doing thing. Simple is beautiful,
Wow,
but simple is not easy.
easy. That's a good one, Amitabh.
Okay, it's counterintuitive, but simple is not easy. Huge opportunities for wealth creation for people who are able to handle volatility. You survive, you make money. You be very careful of the content that you consume. Okay, and one thing which I have seen and which I would love to reverse is that a lot of youngsters and even senior professionals have lost the habit of reading.
Hello all and welcome to the next episode of Bold by BlinkX. Today we have a very special guest, Mr. Amitabh Mohanty. Amitabh is the MD and CEO of J Mutual Fund and he has got wealth of experience in asset management. Thank you so much, Amitabh, for sparing your time on a Friday to join us on this podcast.
Thank you so much, Kalyan, for having me.
Thank you. Amitabh, certain topics which are going to be very close to our hearts because we have seen the mutual fund journey so well. So let's start with the first one, 2026. Lot of issues, lot of problems, lot of challenges, lot of opportunities. Now, from asset managers' lens, what do you think are the 2-3 macro forces that will matter the most for the markets this year?
See, I think what the last 1.5 years have shown us and the way things are panning out, at least the next few quarters that are going to show us, is, and I don't know whether it's how does it impact BlinkX, but trading is going to be extremely tough in these markets. We would advise people to zoom out.
Okay.
We in the investment business look at something called signal to noise ratio.
Okay.
And I think the noise levels are shooting through the roof.
Highest decibel possible.
Absolutely. And therefore, it's very, very difficult to try and isolate signal from this noise and remain focused on that. I think it is a true blue asset allocation environment.
Okay. Okay.
You cannot be all in or you cannot be all out.
Okay.
Okay. And furthermore, when I say that, I'm not only talking about commodities and equity and fixed income, and I'm actually telling some of our investors and partners that we have to look at real assets in a very meaningful manner,
Okay.
which includes land.
Oh, okay.
Which includes land. See, we being in the financial markets have stopped thinking beyond paper assets.
Absolutely. Bag on.
Even commodities, etc. We are looking at paper derivatives of the underlying. I think at some point of time we have to look at real assets for their physical nature.
Okay.
Not only the economic benefits arising out of those assets. I think therefore going forward it's back to first principles.
Okay.
No asset is going to deliver everything, and but every asset will deliver something. Okay, and therefore, and especially in India, if you look at it, equity is still a developing new asset class for the investors at large. A large part of our household generational wealth has been created through physical ownership of land and gold and precious metals, etc.
Correct.
I think it's time to also look at those.
Wow. So it's like going back to basics.
It's going back to basics, going back to something which I think 1 or 2 generations before was doing thing.
True.
And I think it is also a reversion to mean. Since first half 2024, the markets have changed materially. The DIY, derivative strategies, trading, lot of these avenues are becoming more and more suboptimal, and therefore people have to be very careful about what they do. And the best part of this is simple is beautiful.
Wow.
But simple is not easy.
Easy. That's a good one, Amitabh.
Okay, it's counterintuitive, but simple is not easy. Activity is not productivity. Okay, so sometimes you just have to pick your asset class, do your asset allocation, and just sit on those allocations across volatile times. I think that's what is going to help us as fund managers and as investors for the next few years.
Okay.
Having said that, I think what has happened is we swung, the pendulum swung too far to one side of thinking money is making is easy.
Easy, yeah.
And now it's swung to the other side where, it's all gloom and doom. I think I am very, very bullish on India as an investment destination, both domestic and foreign, for the next 2 to 3 decades.
Okay.
And I personally believe that India is going to give huge opportunities for wealth creation for people who are able to handle volatility.
So that the balance is required. The
Balance is
simplicity has
required
be
to
there.
survive periods which sometimes can be extended periods of bad markets, volatile markets. That is the name of the game. You survive, you make money. The markets will recover, markets will change for the better. But are you out of the game because of highly leveraged bets or anything like that? So I think people have to move back to investments and not trading, not speculation. And these markets, even the current markets, given what has happened or what is happening on the Iran, US, Israel war front, we always look at these kind of situations as great opportunities to buy some very, very good stocks at very reasonable prices. And sometimes the foundations of the next bull market happens during these period of crisis, and that's what I want people to think about that rather than react in a knee-jerk fashion.
Wonderful, wonderful, Amitabh. So if I just kind of summarize whatever I've learned in this conversation is first is it's go back to basics. Second is simple is not easy while it is beautiful. And it's not gloom and doom because in the next 2-3 decades you see the markets giving enough opportunities for Indians if they keep their basics intact. If I can.
Absolutely. I personally believe India for the next few decades, not few years, is a buy on dips market.
Okay.
It is not a sell on rallies kind of this thing. So people have to keep that in mind.
Wonderful. Amitabh, that's been an amazing, amazing understanding that you've shared. Now, geopolitically, since we are seeing an extreme fragmentation, do you see shifts eventually coming into India? I mean, we saw some pullouts last year, but how is the situation?
See, it's very simple. I don't extrapolate and overthink a lot of things.
Okay.
A lot of chest beating, chest thumping
Yeah.
has happened about FIAs exiting the country. See, FIAs are like any other investors.
True.
It's just that their palette has a lot more options than maybe most of the domestic investors. So we try to do sector picking, asset picking, stock picking from a domestic perspective.
Correct.
They do it on a global perspective.
Yep.
Right? So please understand that why do they look at India? They look at India as a growth story. And growth at a reasonable price, if they get it, they will look at it.
Yeah.
So last few years, growth has been slightly murky. You had a currency which was overvalued.
Correct.
And you had valuations in the market on a broader sense which were frothy. So 3 very good reasons for them to have exited. And
True.
in hindsight, they've done the right thing.
Absolutely.
Right? The reverse is that when these things correct, for example, if I look at valuations, they are not as frothy as what they were. Rupee has depreciated meaningfully and is at worst fairly valued, at best maybe undervalued.
Okay.
And slowly but surely, but for this event of the war, growth seems to be slowly but surely coming back. So I think it's a matter of time before these guys come back. And as I said, it's not that they are against India or this thing. If they feel that the investment destination validates their hypothesis, they will invest. Otherwise, they will exit. It's as simple as that.
It's like its economy is stupid or its economics stupid. That's the
Yeah, it is. It is. So I really can't understand why we make it a so much pro India, anti India kind of a this thing. We have to be more mature, not as thin skinned as a lot of us tend to be.
True.
Okay, and we see the reason rather than um, so it's I think it's Occam's razor is what I this thing, that sometimes the best explanation is the most simplest explanation.
Absolutely.
Right.
Absolutely.
And we have to look for the simplest explanation, and if we are doing something which is suboptimal and we can turn that around, we should do
We
that.
should do that. Wonderful. Now, moving to interest rates, that's been a big theme in the last few years. You still see some surprises, or you think that the markets have adjusted to the
See, I'll tell you this, the current RBI governor, Mr. Sanjay Malhotra, he has a very different focus compared to the previous governor, Shaktikanta Das. Both are operating in different environments, but the way I look at it, the current RBI governor is very pragmatic about letting the rupee find its own level, as long as it does in a broadly orderly manner. He has been very, very focused on ensuring there's adequate dollar supply to whoever needs it at the right levels. He has tried to maintain adequate levels of liquidity in the system. He's reasonably growth focused. He's okay with inflation where it is right now, even maybe slightly higher than what it is. So I personally think he has already done a lot on the interest rate front. I think what will happen going forward is people will be watching for supply, and if the supply is on the higher side like it looks, you will see the curve becoming very steep. Okay, so you are seeing with all these rate cuts, our 10-year has gone up from around 6.3 to 6.7.
correct.
So while rates have been cut, liquidity has been infused. Yields have gone up by 40 basis points. Right, short-term yields have come down. So the curve has become steeper. I think at the margin we do not expect the longer end to flatten a lot.
Okay.
I think a lot of supply to be absorbed by the markets, and given the volatility in rupee, I do not see a lot of FIIs coming to buy bonds in India at the moment.
For the moment, yeah.
Yeah. So therefore, I think the longer end will continue to remain elevated. I am not seeing too much of bad news there, but I am not even looking to play duration at the moment.
Okay.
But from a broader economic perspective, adequate levels of liquidity, transmission mechanisms being reasonably efficient, and if you look at it, corporate balance sheets, bank balance sheets, extremely pristine right now.
Absolutely.
I think there's a lot of leeway for re-leveraging to take place, and I think once the murkiness on the macro front reduces, I think you will start seeing private capex also building up.
Wonderful. Given the growth returns that India has seen, the markets have seen in the recent years, and we also obviously discussed the valuations. As an asset manager, how does one balance optimism and discipline related to valuation?
See, I'll tell you very honestly, Kalyan, we are called asset managers.
Correct.
We are actually risk managers.
Wonderful. That's a different perspective.
So the point is, I think that the broader trend of the Indian markets will ensure people who stay in the game make money.
True.
It's not very complicated. It's how you handle risks during drawdown periods, during market volatility, is what is going to define how you perform during tough times, right? I think we are more focused on the risk management part of it rather than trying to. Obviously, we have a very strong research team. We have a very strong fund management team, and we are continuously looking out for good companies to stay invested in. But the basics remain the same. Don't overpay. wait for the market to come to you. And unlike in the 2020 to 2024 kind of a market, where there was a sense that if you miss something, you miss it altogether. This market does bring stocks back to you if you are patient and you are sensible about it. So we are just trying to be sensible, as I said, clear in our thought process, identify good companies, have our parameters in place as to how we define acceptable valuations, and when the markets come in our favor, we look to add to them. So we are being very calm about it. There's no point being too frenzied. I think when the markets are volatile and things are this thing, people who are going to have the wits around them will continue to do it.
But here's the thing, Amitabh. If you look at SIP inflows, the quantum jump that we saw, building all the way from COVID to now, and if you see the stoppages of SIPs, it seems to be equally alarming. How does one learn the art of being patient?
See, I'll tell you, I have a very, very simple anecdotal kind of this thing. I always tell that why has the average Indian household, average, made a lot of wealth in real estate and maybe gold? Because we don't mark to market it on a daily or a weekly basis.
Absolutely. Bang on, Amitabh. Yeah.
Okay. So the whole point is, if you keep looking at your portfolio every day, keep pegging to what you bought last week to this and all, you will have a tendency to react. And as I said, noise and signals. So are you reacting to noise or are you reacting to signal? Okay. So this was not unforeseen that when markets turn, you will see number of demat accounts getting closed or a number of trading accounts getting closed or SIPs getting cancelled. This was not unforeseen, but equally encouraging is the fact that gross SIP flows are still holding up. So people are still coming in to continue their SIPs or new SIPs, etc. Even in our case, our SIPs, although they have come down, they have held up very well.
Okay.
I think the trend line has got established. The short-term movements will be across the trend line, but the trend line has been very well established as a upward sloping kind of this thing. And
Understood.
I think this is our investors are much more mature than we give them credit for.
Absolutely. Bang on.
Right?
Absolutely.
I think most often it is we as asset managers or advisors who have let them down than they have let us down.
So it's more the responsibility or the onus on our side than on the investor's side.
It behoves all of us to behave in a more responsible manner. And I think the new generation of investors may be much younger to us in age.
True.
But if I look back at my investment maturity at that age and the maturity these kids have, it's day and night difference. I think they are much more savvy with their expectations, etc. And I think our investment community is in good hands.
Yeah, in good shape.
Absolutely.
Wonderful. I really like the fact that you tried connecting how people made money in real estate and gold just by staying. So it's the staying power that determines the growth.
Yes.
And in a way, I think all these apps which kind of help you see your portfolio and buy and sell, also in a way, in a subtle way, has accelerated the exit.
Absolutely. As I said, the social media apps, always in your face news has increased the noise. So while signal continues to stay the same, thereabouts, the noise to signal ratio has gone up significantly. And see, I'll tell you, as human beings, we normally do not associate inactivity with
Intelligence.
Or inactivity with wealth creation.
Yeah.
But in stock markets and investing, sometimes that's the best thing that you can do.
Yeah.
So you actually have to go beyond your basic human instincts to react. Okay. So how you control those instincts end up how you make money.
That's where you kind of become an outlier, saying, you haven't reacted to whatever is happening in the market. You chose to
Absolutely.
keep calm.
Absolutely.
Wonderful. Now let me take you to a slightly different uh, area here. We talk about asset allocation, right? I mean, that's something that all of us need to understand. But with so many videos happening and so many noise, as you rightly said, in social media, why is asset allocation as a concept, according to you? Is it understood? And if yes, great. If not, why?
See, the whole point is we all start with a great plan.
Correct.
And the first time it gets challenged, it's dumped into the dustbin.
True.
Okay. So, as risk managers, we look at two basic concepts.
Okay.
One is risk creep and one is normalization of deviation. Okay.
Can you please explain that?
Yeah. So, risk creep is every day your portfolio or asset allocation, the risk starts creeping up based on the market. Keeps going up, so you keep adding higher and higher allocation to equity or a risk asset because it's paying off in the short term. And suddenly, on the worst possible day, you figure out that your risk allocation is maybe 1.5, 2 times, or even more of what your optimum risk allocation. So that's risk creep, right? Normalization of deviation. This is again something like we deviate from what we do, look at it, and then,
Okay.
for example, I'll give you this thing. Supposing a good PE used to be 20,
Correct.
then it went to 25. We said now new normal is 25,
25.
then 30, then 35, then 40. And suddenly when the market hits, you figured out that, oh, it's not 40, it's a mean reversion to 20 again.
Lovely.
Right? So these are things which we have to be very watchful and avoid. Okay.
Get it.
And that is something which I have seen more people go wrong on asset allocation, not with the ultimate wealth creation, but they ended up with an asset allocation which is much more volatile than their appetite for volatility.
Okay.
And therefore, on a bad day, they cannot stomach the volatility and then they cut on a bad day.
Understood.
Markets bounce back, but if you have cut out, you
get
whipsawed. Right?
Absolutely.
And that's what I always say. See, for me, a lot of people ask me, what is an ideal asset allocation? I said, I don't know. My ideal asset allocation is something I call the sleep index. If the market goes up by 20% or comes down by 20% and you sleep well, that's your
You're correct. True.
That's it. What works for you, it works for you.
This is a really age-old sage kind of a conversation.
It is what it is.
It is what it is.
See, we ultimately invest to create wealth and lead a better life. If that is leading to me not sleeping well or losing my appetite, then why am I doing it?
I would rather blow whatever I earn and feel happy about it.
No, so the point is, you have to see the whole point of investment. And I've read so many very, very successful and iconic investors. The thing which always struck me is the simplicity of their philosophy. The ability to not complicate, the ability is to cut through noise.
Okay.
And have clarity of thought. If we can do that, 70 to 80% of the game has been won already.
But with the proliferation of social media and all that, and with the apps, how does one discipline and say, cut the cut?
See, I'll tell you very honestly, first of all, be very careful of the content that you consume. Okay, and one thing which I have seen and which I would love to reverse is that a lot of youngsters and even senior professionals have lost the habit of reading.
Yeah, I can clearly see that.
Okay. And there are lots of good reading material around, lots of great Twitter handles around, which are really good from a knowledge perspective. But you have to be very picky and choosy. See, social media is a great place to consume good content, but it's also a bad place to get all kinds of... Exactly. So you have to choose that. And how do you choose that? Is if you are reading well, you are able to distinguish a good Twitter or a X handle from a not so great X handle. And that's it. You have to, and then lots of times we talk about Warren Buffett, we talk about Stanley Druckenmiller, but do we implement them in our philosophies? No, we don't. So then there's no use just reading about
Just for
yeah. I don't want to spout wisdom if I don't use it on my own strategies.
wonderful, wonderful. If you look at India's landscape, maybe in the next 5, 7, 10 years, do you see the trend continuing to be the way it is, or you will have people doing the start stop, or you think over a period of time sanity will prevail and that the eventually help, because India has the luxury of too many people, right?
No, but I'll tell you very honestly, I am thrilled to see what's happening in India.
Okay.
And India is beyond metros. If you really want to see what's happening in India, go to the villages, go to the small tier 1, tier 2, tier 3 cities, the kind of infrastructure buildup that's happening, the kind of healthcare that is populating downstairs, the kinds of roads. I personally believe the best quality lives without sacrificing wealth creation is happening in tier 2, tier 3 cities. Right? And that's where the broader India market, India economy is evolving. So it will always, the markets will sometimes run ahead of fundamentals, sometimes the fundamentals will run ahead of the market, but I'm very, very bullish on India. Very bullish on India.
Wonderful.
And I do go to, for business and for some of my personal hobbies, etc. I do go to some of the most remotest areas of the country, and the way they are getting integrated, the way knowledge is this thing. And the most important thing I'll tell you, Kalyan, which encourages me a lot, is the average Indian parent, even someone who is not very well off, the importance they ascribe to education of their kids.
Yeah.
It's huge.
And I'm seeing the difference, yes.
It's huge. And it's something that's a huge demographic dividend for the country.
It will eventually start paying off.
No, it is already paying.
Sorry.
And I'm telling you this, and you are seeing this, that some of the new success stories are coming from tier 2, tier 3 cities.
True.
The hunger to achieve this thing is coming from the concept of Bharat, not India necessarily.
Absolutely.
Right. And that's what's going to see. Just imagine that we are starting to touch $3,000 per capita.
Yeah.
The inflection point is going to be huge, huge. And that's why I don't even look at the noisy news flow at all. It just deters me from doing something that is sensible.
And simple.
Absolutely. Absolutely.
Wonderful.
So I'm very, very optimistic.
Lovely. So since I know your love for forests, Amitabh, do you think there is a parallel to something that is close to your heart, which is forest and jungles and the financial jungle?
See, it helps me with a lot of perspective.
Okay.
Okay, nature has its own way of imparting wisdom to you if you care to sit there and enjoy it.
Yeah.
Okay. Like someone says, nature doesn't hurry yet it achieves everything.
Correct.
Right?
I mean, it's so profound, yeah.
Yeah. See, when I see the balance that nature has, for example, I go to jungles a lot, as you said, and I've seen our national animal, the tiger, in various moods and various situations. I have seen a tiger who has recently had his fill walk with 50, 100 deer just 15, 20 meters away and not even take a look at them.
Wow.
Okay, it's not that, oh, let me kill 5 or 6 for a rainy day or something like that. That's one. Second, the average success rate of a tiger's hunt is hardly 10 to 15%.
That's it.
That's it. So if they hunt 10 times, they'll be successful once or twice. But I've never seen them panicking, getting frustrated, growling. Each time they miss, they just sit down, recoup, take their breath, then try again. It's not, oh, I'll try and buy stocks and trade a lot more.
So different from the so-called animal spirit we speak.
That's what I'm saying. That's what I'm saying. And what I've also seen is, as I said, my exposure to Bharat has been on a lot of these trips. Okay, and that's where I get the confidence from.
Wow.
Okay, and people think I go out to the jungles and all, I think it makes me a better professional.
And a person, Amitabh.
Absolutely.
Because I can see the calmness with which you kind of demystified a lot of noise from the signary. So that's wonderful. Uh, so before I go to a rapid fire where we can have fun, one last question is, if you have to describe successful investing in just about one line, see, I think since you're a good friend, I'll say one more. What would that be?
I don't know. It's if you create wealth which makes you content and happy and lead a healthy life, I think that's it.
You're cracked the code.
That's it.
There's no perfect.
Live life while you create wealth.
Correct. Don't lose sleep.
And don't miss out on life. Don't miss out on life.
And this is coming from somebody who's an ace asset manager himself.
No, not ace or anything like that. That helps the balance. See, the point is today world has become so uncertain and all. We all save for a rainy day. We'll forget to have fun during sunny days, right?
Lovely, lovely, lovely. Yeah, I mean, I've had so many people speaking about the rainy day, Amitabh, and very rarely do you come across somebody who speaks about living your life on a sunny day, right? So amazing. I mean, pearls of wisdom, Amitabh, and seriously, you have demystified a lot of stuff which I had associated with you, in the sense that, asset managers having that sense of aggression, but what I'm seeing now is completely calm, composed, and the age-old wisdom of saying, lead a simple life, but simplicity is not easy, and stuff like that. And what works for you probably doesn't work for others.
Absolutely. You have to figure out your own
stuff.
Yep.
Lovely. So let me get you out of your comfort zone right now with a rapid fire. The basic rule is you will not think. You will answer without giving it a thought. We want to see what is on top of your mind. Yeah. So we'll start. Bull or bear markets. Where do investors learn more from?
Bear markets.
Bear. Wow. One investing mistake you see too often.
Not handling volatility better.
Better. Wow. Long-term investing in one word. Only one.
Stay invested.
Stay invested. More dangerous for investors, is it overconfidence or impatience?
I would say both.
Okay.
At the margin, impatience.
It's more bordering over impatience than overconfidence. One habit, given that you've been in the markets for almost 3 decades, one habit every investor should build early.
Learning to breathe deeply during volatile times.
Oh man, it's so prophetic, more so it sounds. Given the fact that so many people say so many things, you just say, just step back. Is that what you're saying?
Yes, just breathe.
Just breathe. Sounds slow. I mean, this reminds me of a good movie where they say the count of a breath is what matters.
See, I was just reading something about Jeff Bezos.
Okay.
So someone told him, one of his employees, I don't know, senior, junior, that Jeff, your ideas are destroying the company. So he went back and thought about it and decided that anytime an idea comes, he'll sit on it for a week or 10 days and then see whether it's still as appealing as it was. Okay, he said, when you slow down, a lot of your frivolous ideas get filtered out. Right? It's a different way of saying just breathe and stay calm, work through it rather than just spout it out or
As a compulsive human behavior.
Don't react.
So
stay calm.
Just stay calm. Right. So Amitabh, one question that I have for you is, how does one choose a mutual fund? Is it performance, track record, fund manager, the group association? How does one go about it?
See, I always like to look at a fund manager who has seen cycles. Okay, I will, rather than look at last 1 year or 2 year returns, I would bet on the fund manager. Okay, and that has worked very well for me in most of my investments. people who have gone through cycles know how to handle cycles. That's point number one. Point number two is don't select a fund across a bull market or a bear market. Look at it across a market cycle.
Has it gone through its own trials and errors?
And has it outperformed over a bull and a bear market cycle? There are funds which will do extremely well during bull markets, but they will also do poorly. Is the underperformance lesser than the level of outperformance in a bull market?
Correct.
Okay, different people have different styles, right? So it is, yes, there will be certain styles which will do well in bull markets, certain styles will do well in bear markets. If I were an investor, I would look to see a fund performance across a market cycle. I would like to look at a fund manager who has seen market cycles. And most importantly, if no part of your portfolio is underperforming, then you are not diversified enough.
Okay.
At all points of time, part of your portfolio may not be hugely underperforming,
but there has to be a dip.
There has to be not necessarily a dip, but what returns your outperforming part is doing, the other part should do substantially less. How you asset allocate and all is fine, but if every part of your portfolio is doing great, either in bull markets or in bear markets, become worried, because when the markets turn,
Either ways,
your portfolio might do the reverse.
Wow. So, I mean, that's an interesting way of looking at it, Amitabh. I've been investing in mutual funds from 90s, but this is something that has not come. I always stupidly believe that diversification has to play off, but
No, it does play off. But as I said, see the way we look at it, and when I discuss it with my fund managers, and it applies to same to the investors also. A portfolio is not a collection of stocks. A portfolio is a team of stocks.
Oh, okay.
Okay, we all talk about the heydays of West Indies when we used to have Viv Richards, Clive Lloyd, Desmond Hayes, Gordon Greenwich. We tend to forget that there were players like Gus Logie and Larry Gomes as well.
True. Dujon,
right?
Yeah.
So he used to give that kind of stability to the
and heft to the
so sometimes your stars would not perform, so you could fall back on these guys. Similarly, when you build a portfolio across assets or across stocks, each part of your portfolio is contributing something. Someone is contributing volatility, return, someone is contributing stability, someone is contributing that if your market views don't go out, protecting the downside. So that's how you build a portfolio, and that's true for fund managers, that's true for investors as well.
And these principles remain irrespective of the markets.
Absolutely.
It's market agnostic, it's time agnostic.
Absolutely.
Wow.
See, these are principles 101.
True.
Fundamental axioms which you have to fall back on when you're building, and at all levels.
And also when you have your self-doubts, you still go back to that and say...
So that's when process takes over, right? Yeah, that's when you have to have a very strong process in place. See, process is not for good days. Process is for bad days.
Yeah, I get that. I totally get that. Yeah. Wonderful, Amitabh. It was so nice talking to you on this podcast, and I'm sure our audience would have had a great time learning as much as I did, and we hope to have more such podcasts with you. Thank you so much. Thank you. Thank you all for being a patient listener. Thank you.
Investments in securities markets are subject to market risk. Read all the related documents carefully before investing.